So today I got a special for you because we've gone through the 5 steps. Now we're at the very last and the funnest stage of everything, and that's going to be that closing day. So stay tuned as I'm here with Jason Layr again from Edge Home Financing, and we're going to break down closing just for you. Good morning, everybody. I'm here with Jason Layr again from Edge Home Financing. At least I got your business right this time.
There you go.
I appreciate you being here with us today and joining us. This is the last series of really taking the home buyers through the process. It's like starting off from assessing your goals. Of course, you were here for pre-mortgage and then refining the search and everything. So we are finally here at the closing, and this is the most exciting time, but also the time where, like, as a real estate agent, when I'm watching the buyer or the seller, depending on what side I'm in, I watch the endorphins just drop automatically. It's just like they had all this build up, and then all of a sudden they're just exhausted afterwards.
Here's all the money. Here's the big money part of it, and signing all the paperwork and all those things. Yes.
Yeah, exactly. And that's what we're here to talk about today, as you know, and everything else. And you lead it right perfectly in the first question. By the way, I do want to apologize to you today because I am wearing a new cologne. It's inspired by Daddy Yankee, called Gasolina, because when I went to fill up my truck, it spurted all over me and I had to go back to the house and change.
Nice. A little bit of musk for you.
Yeah, a little bit of musk. There's a little bit of curve over that too now, but at least I got a different shirt on. Oh my gosh.
Well, what questions can I answer?
Yeah, absolutely. So I got a CD and I got the master closing statement here in my hand, and I'm just going to kind of go down it, focus on some things. But the first thing and I get this question from a lot of buyers, especially new home buyers, the difference between, like, when they look at their side, you got the seller side on the master statement and the buyer side. They got the debits and the credits. Mm-hmm. What does that mean?
So as far as for the buyer's side, your debits are stuff that is money that's coming to you, and your credits is money that's gone out. So you'll see your earnest money will be on the credit side, your option money that you paid. On your debit side, you're going to get your payment in from your lender. So whatever your purchase price is, that's what's going to be over on that side. So they get real confused with it. The main thing is making sure that your numbers at the bottom balance. Mm-hmm. Make sure that everybody's the numbers are right for who's giving money to each side of it. Like, who's paying for survey, who's paying for title, is there a home warranty involved, who's paying for it. Making sure the taxes line up for who's responsible for which side of the taxes, all those types of things. That's the biggest part. Now,
speaking of the taxes there, so when you're purchasing a home, it's like some people wonder, like, why at some times a year is the closing cost so high for a buyer. So let's say, like, if I purchase a home and it's February and now they're taking $9,000 just out in taxes. Why is that?
So depending on the year or the time of the year that you close, depends on how much they collect in, number one, your prepaids, and then also in your escrow accounts. Taxes are a big, huge piece of that because your jurisdictions for your counties, at least here in Texas, they send out the tax bills in October. And your lenders who have escrow accounts built for their clients and for their accounts are going to pay those taxes at the end of the year. Now, everybody knows that when you get your tax bill, if you don't escrow, your tax bill is due January 31st. Mm-hmm. It's not the way it works for lenders. Lenders pay it in the fall. So if you close, say, in October or November, you're going to have that whole year's worth of taxes collected, plus your escrow account also has to be funded for an additional, usually 3 months worth of taxes. Now, so you see a huge amount in that closing.
Now, typically, when you're closing later in the year, your closing costs are going to be a lot less because the seller is going to prorate those taxes, correct?
Right. So if you're at the end of the year, your seller, and this is one thing with the sellers, is they'll see a huge balance for what they're having to pay, because when you close, say you close November 1st, that seller is responsible for taxes from January 1st through that day of closing. No, it's not next day, it's not the previous day, it's the day of closing that they're responsible for. Mm-hmm. So you'll see a credit on that for the seller that has paid those taxes to you. So your closing costs are high, but you're also going to see a big credit from the seller to balance that down. Now, if you close in February or whatnot, depending on your lender, is depending on how much they're going to fund into that escrow account. So your closing costs, you can see sometimes 3 months, sometimes 6 months worth of escrow. So
okay,
that's why you see that. The time of year is a big thing.
That definitely explains a lot, because it's like I tell a lot of buyers as they're coming through, they're like, I was not expecting this much in closing costs, and I'm like, well, your lender is collecting a lot up front in the property taxes to put in your escrow so it can be paid at the end of the year.
Insurance does that too, and a lot of people see that as a huge cost as well, because insurance, you not only have to pay a full year of insurance at closing, so you got a 12-month payment that you're going to pay for your prepaids with your insurance, but then you're also going to pay 2 to 3 more months worth of buffer for that escrow account as well. So if you say you have a $2,000 a year payment for your property taxes, you're gonna be looking at 20, or like if it's $2,000 a year, you're gonna be $2,400, $2,600 that you're gonna pay at closing just for your insurance. So that, and then you couple another thing with taxes on there, and you got another $5,000-$6,000 worth of taxes. Man, that's $8,000, $9,000 that I'm paying right away.
And we hadn't
just in tax and insurance.
we hadn't even just got to the lender yet.
You haven't looked at the lender costs, you haven't looked at title, you haven't looked at survey, you haven't looked at home warranty, none of those things.
Interesting. So I never really thought about that. And you talk about the lender and everything else, and we've talked about this before, especially as, just so everybody knows, I went to Detroit to an Edge Financing a real estate agent event, which is absolutely fantastic, because I learned a whole lot more on the lending side. And like what we had talked about is when it comes down to the closing cost and paying the fees up front, whether you want to pay the 1% loan origination fee, or you can get that, you can pay for a higher rate where basically that fee is baked in too as well. But when you're paying that 1% loan origination fee, that can astronomically raise those closing costs too, correct?
Correct. So lenders all do it differently. So, or not all of them, but a lot of them do. So you've got retail, and then you have the wholesale market. And the way that you see those costs kind of in that section A, that first section of your closing disclosure or your loan estimate, those encompass usually what your lender's charging you, so your originator's fee to do your transaction. You'll see program fees, you'll see underwriter fees, all those fees, and that's basically your origination costs are up in that top section. Now, lenders sometimes have the choice of showing those fees there, or they can bake it into your rate. So you sometimes pay a little bit higher rate to not pay that in cash at closing. Sometimes that's beneficial, sometimes it's not. And a lot of it has to do with what you expect rates to do in the future and how long you think you're going to be at that rate for that loan. So if you think you're going to refinance that loan in 12, 24 months or so, it might be to your advantage to put those fees into the rate, because you pay a small amount monthly, and if you end up refinancing now that loan into a better interest rate, you get away with paying less for that fee or that service than what you would have if you paid cash at closing. Does that make sense?
No, it does. So basically, let's say if I do get a good rate, let's say like new homes right now are offering all kinds of buy downs. It's better just to pay that fee up front, or just go ahead and, instead of baking the rate into the thing, just go ahead and pay that fee up front, especially when lenders are offering like not lenders, but new constructions are offering the incentives for the closing costs as well, because essentially they're paying for that, right?
It's all about how long you expect to stay in that loan. Not necessarily that home, but how long you expect to stay in that loan, is if you want to bake that fee into your rate or if you want to pay it cash at closing. And it's the same thing that goes with points. How many points do I want to pay for a lower rate? When I talk to my clients, I always talk to them about what is called their par rate. Like, this is the rate that you get for your situation, your credit score, your debt to income, the house you're buying, the location, all those things. This is the rate that you get that doesn't cost you anything. And you can go one way or the other with that rate. You can either pay points to get a lower rate, or you can take a lender credit and take a higher rate, and then use that credit to pay for closing costs or help with those prepaids with the taxes or insurance we were talking about, those things. So you got your par rate, and then you have your cost for your rate, whether that be a positive cost or a negative cost. And then you also just want to balance it, like, hey, it's going to cost me $2,000 to get a half a point better, but it saves me $50 a month. How long are you going to have that loan to where that $2,000 and that $50 a month savings pays for itself?
Okay.
All the math of it.
So here's a question with these. I got both in my hand. I got the master statement and I got a closing disclosure. What are the difference between the two? Because clients get both of these and sometimes it becomes confusing, because the closing disclosure, if I'm not mistaken, that's where you see everything listed, all fees, everything, correct? Or
So as a lender, I look at the closing disclosure because it breaks out all the fees, and it's going to have multiple pages breaking everything apart. Your settlement statement, that's kind of your title document that they use to balance, make sure the buyer and the seller's accounts balance, that the numbers all equal the same. As a buyer, your closing disclosure, I mean, that's going to walk through all your sections of your costs, from your origination costs, your government fees and costs. You're going to go through title expenses. You're going to go through your prepaids for your tax and insurance. You can go through your escrow account. All those things are broken apart throughout your closing disclosure, and that's the one that I look at, and I make sure that the numbers on that balance to what's on the settlement statement. But to me, it's much more useful to look through a closing disclosure or look through a loan estimate.
Now, when you're working like with the title company to make sure like that everything is balanced in there, what issues or have you ran into any issues with you and what? So
every now and then you'll have an issue with a charge to either a buyer or a seller that's not accurate. You know, there's a survey fee that the wrong party's paying for. I have a situation right now where a amendment to the contract was just missing. Like the buyer and the seller both signed it. It was executed, but for some reason title didn't get it. It was just miscommunication between the realtors, and it didn't get to title. And so when that closing disclosure came out and they were going to balance, like the CD was balanced, or the settlement statement was balanced, because both the lender and the title company had everything right. But the closing disclosure didn't have it on there either. So that had $1,000 that was being missed. So those things get missed. I've also seen a lot of issues, especially since August 17th, with the compensation being accurate for the real estate agents. In fact, I had one that we did a loan on up northern part of Texas, that it was a discrepancy between who was paying for the buyer's agent. And the contracts can be a little confusing a little bit, and just walking through that. The title company had the buyer paying for the buyer's agent, but it was agreed upon earlier, and this language in the contract clearly showed that it was the seller paying for that. So we had to correct that and then rebalance those statements.
Oh my gosh.
Yeah, it can get really expensive for both sides. And
yeah, I
really
see that.
Advantageous to one, but not the other. So it's really important to have a good realtor and a good loan officer that are watching those things. And every loan officer has a processor, and they really are the ones that balance that. Like my processor, Sarah, she's fantastic, and she's the one that balances with title to make sure everything, all the lines are where they're supposed to be.
Okay, so when they're getting ready to go through closing, wire, cashier's check, or would you prefer them bringing a whole bunch of wheelbarrow worth of pennies in?
So cash has to be sourced. So that's a whole other discussion.
Have you ever had anybody bring cash to a closing?
I have not, because I have clearly told them do not bring cash to closing. So as anti-money laundering laws that are in place, any cash that is being brought to a transaction or look through, like, so you have to provide 2 months worth of bank statements. We talked about that at the last deal. Anything that's a major cash influx into those accounts has to be sourced of where it came from. And here's a big one. If you're getting a gift, what is it? Is a realtor, let's ask this question. If you're getting a gift for your buyer for their down payment, how should that buyer get that money? What's the best way to do it?
It'd be wired from the account or cashier's check.
Title directly.
Oh.
So if you wire it directly to title, it makes the sourcing of those funds easier. If you wire it and send it from the gift person to the account.
Oh, then you got it. Then it puts a flag on the lender, right?
Well, because I have to go back and source the funds where they came from, but then I also have to source their funds from where they came from. So it's not enough just to get the bank statement from the person that gave the gift. I also had to figure out where they got that money from.
You know what's interesting? I've never had anybody gift for anything as far as any of my clients yet.
Really?
So I don't know if their parents just don't like them or what.
So, I've had it happen quite often, but the easiest process is to have the money sent to title by the person that's providing the gift at closing.
That way it doesn't affect anything.
It makes it so much easier. And as far as your original question, it depends on the title company. And it also depends on the amount. Usually anything less than, I think it's $500 for most title companies, you can write a personal check. That's not a big deal. And then cashier's checks can always be used, but that cashier's check has to clear before they release funds. Yep. So,
and then if you don't release funds, of course you don't get keys yet.
Exactly. Wire is best. Now, after you close and everybody's signed, Most of your lenders out there have to give funding approval, and then for wires to go out. So timing for when you sign is also important.
Okay, so there are people out there, and I have talked to them, I've met them, that are skeptical of wires. What do you say to those people that are skeptical of wires?
Be very careful. There is a whole lot of wire fraud out there.
Which they have a right to be skeptical of it too,
Yes.
as well.
So every title company and every lender for that matter always has disclosures, almost always has disclosures at the bottom of the email saying verify. So whenever you're sent a wire transfer instructions, pick up the phone and talk to that company to make sure that those are the correct amounts and the correct figures and the correct account number.
That's the same thing I tell my buyers, because they're like, hey, someone just asked me for a wire. I go through, look through the emails, like, yes, it's from such and such a title. Hey, give them a call and just verify.
Yep, and I mean, I've gone at prior work that, man, it was barely a week, 21, 22, when the market was just absolutely insane. There was barely a week that went by that I didn't hear of a situation where wire fraud was happening and somebody lost $100,000, $200,000, $300,000.
Oh my gosh.
So, because they said, I got an email from title company that their wire instructions changed, so I sent the money to that, and that wasn't from us.
That's absolutely weird, man. That's crazy.
It's horrible.
I couldn't imagine someone going through that.
Yep.
So especially when you work so hard to protect them.
Yeah.
And then something like that happens at the end, man. So
It's bad for everybody. So, what are the questions?
that's really it. I think we hit the head on the nail. Just like really going through closings. I mean, do you have anything additional you want to add?
Not really in particular. I mean, settlement statements, the important thing is that, well, and actually, I guess this is a good point. Everybody's looking for what is called CTC, clear to close. So,
That's a real estate agent's favorite words, but yet it doesn't ever seem mean clear to close.
So, getting into the lending side, I always had a question when I was doing transactions before as a realtor that, man, I got the clear to close, and then we're doing all this other stuff. Like, isn't clear to close like we can go sign and close? No, it actually is not. Clear to close just means that the borrower's approved, but there's still a lot of work that has to be done. So you don't start balancing with title until after you're clear to close. Lawyers don't see it. Lawyers still have to approve the survey. There's still lots of work to be done there.
So to paint that picture out there for everybody, Jason knows because I talked to him as well. I had a deal that we were clear to close, and we were coming up on the day of closing. Get a call from the lender. We are not clear to close. I'm like, what happened? I'm not going to go in the story what happened, but it goes right to Jason's point. Clear to close does not necessarily mean clear to close.
Yeah. So, and then there's also funding. So one of the top lenders that I use on a regular basis, whenever they're clear to close and they sending documents out is the key. Like whenever closing documents are sent, once that's done with this lender, everything is clear, it's all done. They actually wire the funds to the title company at like 2 o'clock in the morning the day of closing, because everything on their side is done. Most of your lenders out there, they don't actually clear everything until after everybody is signed and somebody has gone back there and reviewed everything. So there could be other conditions that have to be done there right at closing. Well, super inconvenient.
Well, that brings me to another question then, like as a buyer, so my funds get released, what is a safe time to close at during the day?
So usually your wire cutoffs in most cases at 2:30 in the afternoon, 2:30, 3:30 in the afternoon.
So you want to be signed before that time?
Well before that, if you
okay.
can. Yes. So the earlier you can close in the morning, the better. That way, if there is a complication, there is a problem, that there's time to get that settled. Because you're not going to get the keys until everybody has their money. And it's not saying that everybody actually has their money. The seller probably won't actually have their funds. What you're looking for is that email from the title company saying that we're closed and funded. That means that the keys can be released and the property is now turned over. Because it's just a matter of time for the title company to release funds to each of the parties.
Yeah, absolutely. Well, Jason, again, I appreciate your time and everything else so much. And guys, I'm going to be bringing Jason on quite a bit because it's a great flow here, great conversation and all. Yeah. But if you have any questions directed to Jason, please let me know. Comment below, and I'll get you right in contact with him. He's with Edge Home Financing. He's just a box of knowledge just walking around. He helps me out quite a bit on some deals.
Try to. Well, yeah. And the taxes and stuff like that, those are probably some of the most confusing parts of it about how much you're going to get. So yeah, questions anytime.
Yeah. So. Well, guys, this is going to complete this 6-part series of just taking you through buying the home. What I would like to know from you is like, what would you like to know more about the home buying process? And I would be glad to set this up. But also please like, share, and subscribe to the videos, because I mean, I'm going to continually be doing this every week, every single week, just to educate buyers. And also we're going to be having series in the future also for sellers, preparing their homes for selling, or just taking them through the selling process. But again, as I said, please comment below. I want to hear what your thoughts are. And until then, I'll see you in the next video.